You need to understand something that the news anchors will not tell you because they are too busy celebrating the headlines. Oil just shattered below $85 a barrel. Brent crude fell from nearly $126 at the April peak to around $83 today, a drop of over 30% in just a few months. The mainstream narrative says this is a peace dividend, a gift from the U.S. Iran deal that will put money back in your pocket and send stocks soaring. And yes, the S&P 500 futures surged, Asian markets rallied, and the volatility index dropped sharply. But I'm here to tell you that this is a massive signal for your stock portfolio, just not the signal they want you to believe. The wealthy were not caught off guard by this collapse. They positioned for it months ago. They sold their energy stocks into the war premium and bought the sectors that would benefit from lower oil. And now they are watching you chase the headline while they quietly rotate into the assets that will survive what comes next. The question is not whether lower oil is good for stocks. The question is whether you understand which stocks benefit and which ones are about to get destroyed by the aftermath. Let me give you a real example of two investors who saw this moment coming and one who did not. The one who did not is a client I will call Tom, a retired engineer in Texas who loaded up on Exxon and Chevron during the conflict because he believed higher oil prices would last forever. Tom watched his energy stocks rally 25% year-to-date, felt brilliant, and ignored every warning that the peace premium was temporary. Then the peace deal was announced. In one session, energy stocks traded down sharply as oil tumbled. Tom's portfolio lost 5% in a single day. He is now sitting on shares that trade at a 28 times forward PE, a multiple that only makes sense if oil stays above $90. It is not going to stay above $90. The investor who saw it coming is a client I will call Susan, a portfolio manager in New York. In March, when oil was spiking and everyone was buying energy, Susan sold half her energy holdings and bought consumer discretionary and technology stocks. She understood that falling oil acts like a tax cut for consumers and a margin booster for companies that use oil as an input. When the deal hit, Susan's portfolio gained 3%, while Tom lost 5%. Susan did not outsmart Tom because she has a crystal ball. She outsmarted him because she understood that geopolitical risk premiums always unwind, and the real signal is not the price drop itself, but the macro shift it unlocks. J.P. Morgan's chief market strategist just confirmed that falling oil prices could provide a massive tailwind for global stock markets by prompting a broader equity rally and clearing a path for central banks to cut rates. The Fed's rate cut odds for September just jumped to 72% from 64% pre-deal. That's the signal, not the oil price, the rate cut. And Tom is still holding energy stocks, while Susan is positioned for the rotation into a wider range of sectors. Let me show you exactly why this oil collapse is a massive signal and what it is telling you about your stock portfolio right now. The signal has 3 layers, and most investors will only see the first one. The first layer is the obvious one. Lower oil means lower inflation. Goldman Sachs estimates that every $5 per barrel drop in Brent reduces U.S. inflation by 15 basis points annually. That is real. It means your grocery bill, your utility bill, and your gas bill all get some relief. The second layer is the central bank response. With inflation cooling, the Federal Reserve has room to cut rates. J.P. Morgan believes the deal could reduce inflation expectations enough to give central banks greater flexibility to lower interest rates. That is a massive tailwind for growth stocks, technology, real estate investment trusts, and any asset that is sensitive to interest rates. The third layer, and this is the secret that Wall Street does not want you to know, is the sector rotation that is about to happen. Historically, when oil prices fall from a supply shock peak, money flows out of energy and into consumer discretionary, technology, and financials. The MSCI analysis of past geopolitical shocks shows that U.S. equities tend to hold their ground while international markets, particularly Europe and emerging markets, get hit hardest during the spike. But when the conflict ends, the reversal is just as powerful. European and emerging market stocks, which sold off more sharply during the war, are poised to benefit the most from the resolution. That means your portfolio needs to be overweight the beneficiaries of lower oil and higher growth, not the sectors that just lost their crisis premium. The energy sector is less than 4% of the S&P 500, so its decline does not move the index much, but the rotation out of energy and into the other 96% of the market is what will drive the next leg of the rally. The wealthy already rotated. You need to do the same. Stop and hear this clearly, because your emotions are your enemy right now. You are watching oil collapse, and your first instinct is either fear because you own energy stocks or greed because you want to buy the dip. Both instincts are wrong. The single most important psychological shift you can make today is to stop treating this as a binary event. This is not good or bad. This is a reshuffle. The peace deal is tentative. The full details have not been released publicly. A permanent truce has not been worked out. Iranian President Pezeshkian said the memorandum is an important step, but a final agreement has yet to take shape. Even if the deal is signed on June 19th, the restoration of full supply through the Strait of Hormuz, which carries about 20% of the world's oil, will take months. Clearing mines, restoring insurance coverage, and getting shippers comfortable to return will all take time. The oil price will likely rebound from these lows as the market realizes that supply will not return overnight. But the bigger picture, the structural shift toward lower energy costs and lower inflation, is real. The UAE already withdrew from OPEC in May, removing about 15% of the cartel's production capacity and introducing unconstrained supply. Gulf nations are accelerating monetization of their reserves before prices drop further. This is not a temporary blip. This is a structural change in the energy market. Your motivational anchor for today is this phrase: I do not trade headlines. I trade the structural shifts that headlines obscure. The wealthy were warned, not because they knew the deal was coming, but because they knew the war premium had a shelf life. They positioned for the normalization. Now it is your turn. Here is your expert solution, and I need you to execute these steps before the market finishes pricing in the second wave of this repricing. Step 1. Audit your energy exposure. If you own individual energy stocks like Exxon or Chevron, check your entry price. If you bought during the war premium when oil was above $100, you are likely sitting on a multiple that no longer makes sense. Exxon's forward yield is 2.80%. Chevron's is 3.78%. Both are safe at $70 to $80 oil, but the total return thesis changes if oil falls to $60. Under the J.P. Morgan baseline of closer to $60, those multiples look stretched. You do not need to sell everything, but you do need to reduce your exposure and reallocate to the beneficiaries of lower oil. Step 2. Rotate into the sectors that gain from falling energy costs. Consumer discretionary stocks benefit when consumers have more money to spend. Technology stocks benefit from lower input costs and the prospect of rate cuts. Financials benefit from the yield curve steepening as rate cuts become more likely. Emerging markets, particularly in Asia, benefit from lower import costs and stronger growth. J.P. Morgan analysts noted that cohesion within OPEC is showing signs of fragmentation, creating downward pressure on oil prices that will persist. That is your green light to overweight growth and cyclical sectors. Step 3. And this is the master key that turns a geopolitical headline into personal wealth. You must stop thinking of your portfolio as static. The wealthy are not passive. They reposition every time the macro regime shifts. The regime just shifted from high oil, high inflation, high tension to lower oil, lower inflation, and a potential rate-cutting cycle. That means bonds may rally as yields fall. Gold, which sold off on the peace news, may have further to drop if the risk-off trade unwinds. But the dollar, which weakened on the deal, may continue to weaken as rate cut expectations rise. Your job is not to predict the future. Your job is to align your portfolio with the new reality. The Iran peace deal is not the end of the story. It is the beginning of a new chapter. The wealthy are already reading ahead. You can too. Move.